All right, I'm going to combine problems 24, 25, and 26 because they're all using the same STEM information. So this is problems 24, 25, and 26 from Chapter 2 of the CFA textbook, Corporate Finance, A Practical Approach, 2nd edition. This is the McConaughey Company, or McDonald's Company. I should just change the names. They're talking about buying a press that costs $360,000 and another $40,000 to get it installed. So the grand total to get it up and running is $40,000. The press will be depreciated straight line to zero over a 5-year life. So if the grand total is $400,000, then the depreciation expense each year will be $80,000. They ain't going to generate any revenues, but it'll reduce expenses by $140,000. Well, reducing expenses is the same as earning a higher profit. We could sell the press at the end of the 5 years for $120. When we sell it for $120, since we reduce the book value to zero, we're going to go income taxes on the taxable gain. We're also going to invest inventory of $60,000, which is a cash outflow at time zero, but when we recover it at the end of the 5-year period, we sell off the inventory and simply don't replace it. We'll recover the $60,000. So let me set up my timeline: 0, 1, 2, 3, 4, and 5. All right, so the net investment outlay, or the cash flows at time zero. Buy the equipment, and buying the equipment is negative $360,000. Install the equipment, and that's going to be another $40,000. All right. I'm also going to have purchase inventory, additional inventory I should say, of $60,000. So before I get this thing up and running, my investment outlay, or my initial investment outlay, at time zero is going to be $460,000. My after-tax operating cash flows, if I do my revenue, it's going to be zero for each of the 5 years. My cash expense will be negative $140,000. And when I subtract a negative number, it's actually going to add it back. And then my depreciation expense, all right, the grand total for this of $400,000 depreciated over 5 years, my depreciation expense, $400,000 divided by 5 each year. So if I calculate my pre-tax profit, it'd be the revenue minus the expense. Now remember, when you do minus a minus, it's a plus. Minus the depreciation means that I'll actually have reported income of $60,000 a year more. Okay, pre-tax. I'm going to owe income tax at 40%. That's for each of these years. So my after-tax profit, or my accounting profit, would be $36,000 a year. My after-tax operating cash flow, which is what I use here, after-tax profit, and add back the depreciation because it's a non-cash expense. No money actually changed hands. All right, so there's my initial outlay, and that's the answer to 224. All right. The answer is negative 460,000. Highlight that. The after-tax operating cash flow, it's the same each year because none of the numbers change. It's 116,000. And the terminal year after-tax non-operating cash flows. All right, this will be recover the inventory. All right, so since I spent $60,000 purchasing it back in time zero, when I sell it off, I recover $60,000. Sell the equipment, and when I sell the equipment, I can sell it for $120,000. That'll be a positive cash flow as well. However, there's going to be tax on the gain on the sale. And in the 40% tax bracket, since my book value was zero, I depreciated it down to zero over the 5 years. I'm going to have a negative $48,000 of tax. And if I add all these together, those would be my terminal cash flows, or what they're calling the terminal year after tax. Terminal year after tax non-operating cash flows. Okay? And that's the answer there, 132,000. Okay.